Sometimes fortune favors investors willing to go against the consensus view, those who look for opportunities where others might not bother to. And that's what Benj Gallander is all about. He's one of Canada's best known contrarians who says he's earned an average return of, get this, 19.1% over the past 10 years. So in this episode, we'll take a peek inside this market master's mind, what he thinks about the stock markets today, and how he's looking to pounce on opportunities in the year ahead. You're watching Inside Investing. Hello, everyone, and welcome to Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Rob Moise, and joining us today is Benj Gallander, president of Contra the Herd investment newsletter. Benj is a columnist at the Globe and Mail, and he's also a frequent guest on the likes of BNN, Bloomberg, and all those types of TV programs. Benj, fantastic to have you back on the show. We really appreciate you taking the time. Welcome.
Well, Robert, I really appreciate that you guys invited me. TD is great. I actually use Webroker as my number one place. And I wasn't told I had to pitch that, but I've been using it for years, and it works very, very well for me.
Awesome. Well, we appreciate the shout out, and we're thankful that you're a customer of ours. This contrarian investing thing, you've been at it for a while now, Benj, and the returns are sparkling. If you had to pin something down, what would you say is the secret to your success?
Early on, I did a tremendous amount of reading and combined different systems. I'm a very, very patient investor. Once I discover a stock, I don't buy in for at least 6 months, often years. So patience is absolutely key. Doing a lot of research is critical. Bouncing anything before I buy it off of Ben Stadelman, who I met at the University of Western Ontario 102 years ago. Phil McKellar, who's been with us for about a dozen years, and my son Benj Gallander is doing work for us too. So getting the different opinions and listening to them, and deciding that something that I like and nobody else does, generally that's not a good thing to buy. But continuous learning to me is critical.
It sounds like, the passion for learning and gaining perspective is a big part of this. But, let's say, somebody wanted to take a crack at becoming perhaps the next Benj Gallander. What sort of personality, skills, knowledge do you think that they might have to have as sort of a foundation before they could kind of tackle something like that?
Well, I know there's lots of people who would say, don't do it. Don't become the next Benj Gallander. Stay who you are. Maybe apply a few lessons. I think the key is, again, reading a lot. And then when you're starting, do some paper trades. So step in with one or two toes. Don't go in all whole hog. I read so many books at the back of my Contrarian Investors 13 and Uncommon Investor, two books that I wrote that became bestsellers. There's a bibliography of different books to read. So I think there's a lot of old books that are exceedingly valuable and have stood the test of time. And there's new books that continue to come up. And not trying to be the smartest person in the room. Know that you're fallible, at least I am. If you're not, more power to you. But by admitting to that fallibility, you have a better chance to keep on learning. So I've developed a system that seems to work very, very well for me, but it's not something that's just going to rest there and be inert. I want it to continue to evolve.
We certainly are all fallible. I know I am, just ask my wife. But learning from those failures is kind of what helps us grow. So before we jump ahead and become the next Benj Gallanders here, so to speak, just a quick note to our listeners here. Make sure to subscribe to TD Direct Investing on YouTube so that you can catch upcoming episodes of Inside Investing, and you can check out our library of past episodes, including our last episode with Benj. There's a lot you can learn from there too, so hey, check it out. All right, let's get into it, Benj. And I guess maybe, you mentioned your system there to start things off. So why don't we circle back on that a little bit? Can you just kind of walk us through a little bit about your system for kind of evaluating potential contrarian opportunities?
Well, I basically have a point system, and it has all kinds of different categories in it. But the first thing I have to do is discover a stock. So about every 4 months, I go through all the stocks on the TSX, the NYSE, the NASDAQ, and I look for some that might fit the contrarian mold. So I'm looking at stocks that have basically gone way down in value, normally at least 50%. And then I look where they've been over the past 10 years. So I want to see stocks, say, that have traded at least 100% upside for 7 of the past 10 years or so. Or if not that, that at least they've spiked. So say spiked 3 times over the past 10 years, because there's some stocks that spike and they just can't maintain it. So that can be a good indicator that future spikes would be in the cards. So it's very important that with each stock that I'm looking at, I then go over the financial ratios very carefully. I'm very, very averse to debt. Major reason that I've had blowouts over the past 45 years, I'll keep doing it like that, 45 years, is because of debts. And stocks that have a lot of debt, or they have a debt load that's increasing, those are often the ones that get in trouble. It's the same as people who have too much debt on the books. The bank can come in and say, we want you to pay us. And I've always been very firm in my desire never to have the bank come in and ask me to pay them. I'm exceedingly debt averse. I'm one of the most debt averse people that I know. So by finding these companies that have nominal debt or no debt, I know there's less of a possibility that they will have difficulties. Once I find the companies, I wait patiently, as I said, for at least 6 months, often for years before I buy in, because that gives me a better opportunity to understand what the company is all about and to really learn about the company. So that's critical. And again, I keep saying the word patience. You know, with stocks, if one train goes by, there's always another one coming down the tracks. There's always more stocks that will be arriving. So there's no need to jump at everything that you think might work. So being exceedingly selective to me is absolutely critical. And a lot of people do not have the patience to be selective. And we know that that is integral to good returns.
So you mentioned that you have a like a point system that you kind of scale things on. How does that work?
So it has a lot of different categories in it. So it can vary. They all get 1 to 2 points. Management. I like to see that the company has good management. Hopefully, management that's had success with the company before with another company. Debt. If the company has a lot of debt, I give it -1 point or -2 points. If it has no debt, it can get up to 2 points. So debt to me is absolutely critical. Um, the industry can be very important. I don't want to be investing in an industry that's like slide rules, something that might be dying on the vine. So that's critical. Um, there's a lot of other components in it, but it's very important to also look at the competition that's out there for it. It's important to see where the stock market may be going. It's important to evaluate. And I have a 1 to 4 system whereby a stock I think can go up 4 times or maybe double. I'm always looking really for at least a double, but if I can get a triple or a quadruple, so much the better. And my stocks have often been beaten so badly, so I could be buying a stock at $5 that's traded at $50 in the past. So then I have to set an initial sell target that is reasonable within the history of the company. There's nothing pie in the sky about what I do. I always want to know that the company has traded at that much higher valuation, ideally for a long period of time, or ideally it has at least spiked there, as I mentioned, say 3 times in the past 10 years. So everything I look at is fairly concrete, but when you've been doing it as long as I have, there's also a certain amount that is feel. I don't give a lot to feel, but I think it's worthwhile thinking, okay, is there something here that really attracts me to this stock or makes me look at it negatively? One thing that often attracts me to a stock is if the whole sector has been badly beaten down. If the whole sector has beaten down, that often means that at some point it's going to rebound. So then I do look at individual stocks, but if a whole sector is out of favor, you know, there's a cycle to investing, there's a cycle to life. So I'm going to look and see if that sector could come back into favor, which it likely will, and when.
Would you say that there's something that you might see in a company that really sparks your interest and really moves the needle on your scale, or is it really like a case by case basis and a totality of factors here?
There are certain things that will do it. So say if a company's been doing poorly, but their debt load has been coming down by quite a bit and has been coming down, say, fairly quickly. Well, again, as I mentioned before, there's less of a chance that it will get into trouble later on. But financial ratios are absolutely critical. So if the numbers are moving in the right direction on an absolute term, and if they're moving in the right direction on a ratio term, that can be fairly clear that these are opportunities in waiting for me. You know, if the economy is in a certain way and say we're in a major recession, and there's going to be one, we know there's going to be one. Question is trying to figure out when. Well, ideally, if I can wait and get closer to that rebound time, I will do better. But it's, this is not a perfect science. A lot of people like to make it out to be a perfect science. It's not all going to go well, no matter how smart you might be or how much research you do. At certain points, you're going to get a fist to the face, and hopefully it won't knock you out for too long.
Yeah, certainly it's artistry, not science. If it was science, there'd be a lot more millionaires out there, right? Are there certain types of companies that, or sectors even, that you think lend themselves to contrarian investing? Or again, is it like a really case by case basis?
Yeah, I don't think certain sectors do in particular. What I found over time is that certain sectors go way out of favor, or the market goes way out of favor. But you can look and see that certain sectors are likely to move more quickly coming out of a recession, or certain sectors that are out of favor are going to come back in the next few years. I do know certain sectors go out of favor every X number of years. There seems to be a banking crisis in the States about every decade. And banks, when I was buying a lot of banking stocks, it was evident to me that the banking system was not going to go out of business. Certain banks might go out of business. Technology is a sector that attracts a lot of interest at certain points in time, and you can have fantastic returns in that sector. People have to watch they don't confuse the returns and say seven stocks compared to the whole sector that might not be doing well. But virtually every sector has its day at certain points in time. But having the whole stock market out of favor, to me, is a huge bonus, and certain sectors out of favor is also a bonus. So if that is the case, one or the other or both, it can be a good time to lay money down on the table. And I'll throw a little something at you too. As I think you know, I do almost all my buying in December. And I'm buying stocks that have been beaten down. So what happens in December, you have tax loss selling. So a lot of people don't do it at the right time of year, in my opinion. Right now in May, this is the time of year when I do most of my tax loss selling because I'm getting it out there early. If you wait until December, that means you're going to be competing, so to speak, against all kinds of other people who are also dumping. And if they're also dumping, well, the stock price will go down. And that's when Benj Gallander steps up to the plate and says, now's the time for me to buy. And it's very much an annual cycle. You don't have to be brilliant to note this. This is the way it is. So if you can beat the market in terms of selling your losers and then buy in when people are dumping their losers, and sometimes I find, towards the end of December, one of the stocks on my list will just dive. It'll go down 15 to 20% in a day. and I'm awfully sure that it's just tax loss selling. So I will jump in and buy it. And then what often happens is the last 3 days of every year, I'll just keep throwing ideas at you. And the first 5 days of the new year, the stock market generally does well. Not always, but you often get a 1/4%, 0.5% to the upside during that time. So even though I'm looking at trying to get huge returns, part of that huge return is made by getting a 1/4% here and 0.5% there. So everything I can add on to the bottom line makes me happy.
Okay, so you've given us some great color on on a stock specific level here. Let's talk a little bit bigger picture here. We've seen things like inflation, interest rates, a lot of macroeconomic talk in the news. For the last year, 2 years, even pretty much after the pandemic, really. What's your read on the economy today? Things like inflation, interest rates, and how does that kind of play into your thinking as a contrarian?
Inflation is important, but at the same time, we've been seeing inflation and stock markets have been doing well. And people have been saying, oh my, inflation is so bad. Again, I think we're around historical norms, but we came out of a period where inflation was so low. That's what's going on now seems to be crazy high, so to speak. Like just go back, throw into one of your fine computers the numbers for inflation over the years. They're trying to lower the inflation rate. Again, I don't consider it to be very high. I think people can be far too alarmist. So, raising interest rates to me at this point in time don't make a lot of sense. I would say, if anything, maybe they should be a bit lower. But it's fascinating watching the reaction, not just of investors, but watching a lot of the top people in government. A lot of them, I think, are making decisions that they think will be good for us, but they also make decisions to keep themselves in power. So they're weighing the short term versus the long term, and that can really be damaging to the economy and to people.
Does that dynamic open up any opportunities as a contrarian, or is it kind of just something that we're all along for the ride for, basically?
Well, I think it does. I mean, I said at the beginning of this year, it was very likely that stock markets would do well because in the States in presidential years, the stock market almost always does well because the powers that be want to get reelected. So they might not necessarily be acting for the best reasons. They're acting for reasons that make people say, wow, these guys are doing really well for us, and the economy is doing well, and I'm doing well, and therefore I will vote for these people again. And I can say, I think we do a lot of fairly incisive, fairly in depth research. At the same time, the KISS principle, keep it simple, stupid, can be very, very valuable. And I certainly use it to some degree. This to me seems pretty obvious that in the presidential year, the markets uh, almost always do well.
That said, there has been some grumbling about the wheels maybe falling off the bull market here, and as I understand, you also of that mind. Maybe not right now during the U.S. election season, but pretty soon we could see that take place. Why do you feel that is? Can you give us a little bit more detail on that?
I suspect that next year will not be a good year for the stock market. At least a 10% drop, maybe 20% drop plus before the end of next year. But exactly when that'll be, I don't know. I mean, markets can go up or they can go down longer than they should. They don't necessarily have to correspond with the economy in any way, shape, or form.
Oftentimes the stock market, it's not necessarily a reflection of the economy. So even though there might be some economic worries here on the horizon, potentially, it doesn't necessarily mean that the market would follow. What tells you that the market is going to follow in this case?
The debt and the deficit in Canada, it's extraordinarily high. In the States, too, it's just at untenable levels. Um, it's very, very scary. So the logic is that at some point they'll have to pay the piper, but the politicians don't seem to be willing to do that. You and me know that we can only rack up so much in debts, and then we have to take care of business. We have to take care of them. And then the question is, as investors, where do you go? Some people are going to Bitcoin, which to me is questionable. Some people are going to gold, which to some degree is good, or gold companies. I think a key thing is to have a diversified portfolio at the same time being aware of over diversifying, because if you over diversify, things will work against each other. So it just seems to me that things are high, but again, I expected things to go up now because there's a political will to do that. And that political will might be questionable, but they have a lot more power than, than you would be sitting and postulating about what should be done.
So, how are you then preparing for this market downturn that you see coming on the horizon? We know that you like to buy when stocks are down. What kind of prep work are you doing right now, and what pockets of opportunity might you be seeing emerging from this downturn?
I'm in a bit of a funny position. I have quite a few stocks, and very few of them are near the initial sell target. I wish that more were. This is a time of year I'd love to sell. But again, I'm not going to push things, I'm not going to force things. And at the same time, I'm doing all that research that gets me ready for the end of the year. So much of what I do is study, study, study to be in position to pull the string, so to speak, when I'm going to buy. A lot of it is just staying cool, trying to know the pulse of the market while avoiding it. I try not to focus on all of the gyrations in the market and in stocks too much. I have a long watch list that has about 150 stocks, but I have a shorter list of about 15 to 20 stocks that are the ones that I'd be far more likely to buy at the end of the year. So I've divided that up on the website so that every day during the week and often on the weekends, I take a look and see what the new news is, what's going on with them, what might change my way of thinking.
What pieces of information do you find particularly meaningful ahead of a market crash? Are there little clues that you can get that tune you on to the potential for a stock or a sector, let's say, to do particularly badly when a market downturn happens that might give you an opportunity to get in at a low point?
There's certain signals that the markets are too high, that they don't make sense. Often it's because, it can be that people are very, very bullish and very, very optimistic. That can be a negative indicator. Um, keeping a pulse on the market. If the market doesn't seem to make a lot of sense in terms of its pricing, that's an indicator that it's going to get hit. But again, and if you think it's going to get hit and you're way too early, and you're not investing because of that, that can be costly. If you're selling out, so some people will sell out of everything or sell out of a lot of positions just because they think things are too high. I won't do that. I will sell out of the positions that have reached those sell targets. I may sell out of them a little more quickly at a slightly lower level, but again, after the sell target has been passed. So discipline is key.
There's two worries that investors often have. One, they worry about, when a market downturn is happening, they worry about trying to catch a falling knife, basically. But then the other flip side of that too is folks worry about selling out too early and missing the rest of a bull run. Do you have any sort of tips that kind of help you avoid those situations?
Well, I almost always sell my stocks too early. Again, the initial sell target helps me, but often I'll only sell a percentage. But I would say in the majority of cases, I sell a stock. Not only goes up a few cents, can go up 50%. And I look at it and go, darn. I may use another word, but I'll say darn here. I think it's the nature of the beast for me to a certain degree, being patient and saying, okay, does my thesis hold up? The reason I bought the stock, does it still make sense? If you buy into a position and the stock market gets killed, in most cases, you're going to get badly hurt. But some people say, well, you don't get hurt until you sell. Well, you're down quite a bit. But that's true. You don't lose the money until you sell. So the question is, should you sell and take the loss? But again, if you've invested for the right reasons, over time, those stocks should go back up. And because I'm looking at those huge gains that we mentioned before, 100, 200, 300, 400% plus, if it takes 5 years to go up 100%, that's still a huge return. So if it goes up 200%, again, those are huge returns. People think contrarians don't like dividends. I love dividends because, as you've heard me say before, dividends allow me to be stupid longer. If I'm getting 1, 2, 3, 4% return because of a dividend, at least something is going back in my pocket, and I'm getting the dividend tax credit. So preferential tax treatment. Usually there's good clues. If the dividend is paying out at a high rate, say 8% plus, 10, 12% plus, to me, that's an indication that the dividend is going to get cut or eliminated. So if dividends are too high, that's a good reason to stay away from a company and wait, because again, there's a good chance it'll get cut and you'll get in at a lower price. And almost always, not always, but I'd say 90% plus, when dividends are cut, the stock price gets beaten down.
There is that beautiful saying, there's no such thing as a free lunch, right? And that's so applicable to investing to a 12% dividend. There's probably some catch there. Not always, but sometimes. I also want to ask you too about the way that you approach position sizing and your approach to distributing the amount of money that you want to invest in a particular position or divesting from a particular position when you get the sense that a bear market could be happening or a down market could be happening. What's your rules of thumb there?
I have that 1 to 4 system where 4 I buy 4 times as much as a 1. If I think we're going into a recession, and I think I should buy a stock to the tune of 3.8 out of 4, so that's a high buy. Maybe I'll just buy it at 3.2. So I'll put less money into the positions. I'm willing to double down or add to a position if the stock price gets hit, but I will only do that one time. It's not very often I'll buy at 3.5 or greater. And the last one I bought at that level actually did it really poorly. I'm still holding it. So again, the word I mentioned before, fallibility. I know how fallible I am. Therefore, I'm more conservative than a younger Benj Gallander would have been back in the day.
We really appreciate you sharing all this wisdom with us, Benj. Is there anything that we didn't touch on in our conversation that you just kind of want to leave the audience with today?
Read widely about the market, read widely about other things. So, and then gradually compile the system. Make notes on what you think works for you and figure out what has worked for you. Something I finished off one of my books with, I said, money often costs too much. So money's important to pay the mortgage, to pay the rent. I like eating good meals. Fortunately, I have a wonderful cook here with me. But you want to use money wisely and you want to enjoy money. And, life is very finite. So try and really enjoy it and try and spread some of that joy and happiness to other people.
That's a beautiful philosophy to leave us with there, Benj. Thank you so much for taking the time to join us. And thank you to the audience for tuning in. We hope you enjoy our conversation today. Make sure that you register for our upcoming learning events as well. And you can check out our past events as well on TD's YouTube page, as well as in the Learning Center on Webroker. So hope you enjoy the conversation, and we'll see you all next time. Have more questions? Then check out the links to the right and in the description below.